A fever spike hit the tech sector hard today as SMH shed nearly 5%, the sharpest single-day drop of any major index component this quarter. Capital is fleeing semiconductors faster than it rotated into defensive dividend plays. And the VIX response confirms we are entering a phase where volatility itself becomes tradable rather than priced in. The question isn't whether this correction will deepen. It's what kind of immunity your portfolio builds from today's stress test. Speculative capital is coughing as growth names get exposed. ARKK and SPHB both surrendered too, 57%, while MAGs barely bled a fraction. A rotation that signals smart money exiting momentum traps rather than capitulating entirely. The semiconductor leader SMH dragged everything down with its 447% drop, confirming the tech narrative. Earnings warnings are being priced into hardware names faster than software plays can absorb the blow. Our metrics show speculative risk tolerance cooling to near neutral territory. After running hot through May and June, the engine behind this move is geopolitical friction meeting margin compression. Oil surged 9.23% on US iron tensions, which immediately translates into inflation stickiness fears that threaten Fed policy flexibility. The 10Y Treasury moved 8 basis points, clean enough to suggest institutional repositioning rather than panic selling. What concerns us most is the disconnect between real economic fundamentals and what's happening in equity valuations. Corporate earnings haven't materially degraded, but forward PDS compression has accelerated by 3 standard deviations over baseline. Volatility products are screaming a cardiac event warning. UVXY jumped 4.69%, while VXX climbed 13%, both moves that exceed historical averages for single-day stress events outside of Q4 or post-earnings announcements. The VIX itself sits at 1716, which looks low by panic standards, but represents a 200 basis point spike from last week's baseline. Our fear gauge reads elevated because the breadth of weakness. Nasdaq, down more than S&P, is creating cascading effects in portfolio rebalancing flows that will compound selling pressure tomorrow morning. The real economy is running on autopilot while markets run hot. Consumer discretionary. XLEY dropped 1.44% despite no direct earnings catalyst, which tells us capital rotation, not fundamentals, is driving this move. Industrial production indicators from the past 2 weeks showed resilient manufacturing activity, yet IT only managed a modest 0.43% decline rather than following tech's lead. This divergence suggests institutional investors are using today as an opportunity to rebalance duration exposure while maintaining core equity positions at current levels. Defensive positioning is showing selective strength. XLP rose 0.7% as consumers and businesses simultaneously retreat to essentials, creating a natural hedge against the broader sell-off. The dividend yield theme is gaining traction. Bond dropped only 0.53%, while GLD underperformed at 2.85%, indicating gold's safe haven narrative has lost credibility relative to pure cash flow generators. Our safety trade metrics confirm what the headlines are already reporting. High dividend yield ETFs like JEPI and HIGH are being viewed as alternatives to equities when uncertainty spikes, not merely as defensive overlays within equity portfolios. The hero today is your portfolio's duration positioning. The villain is geopolitical risk meeting tech earnings fatigue in a way that creates cascading volatility flows. The data shows we have entered a phase where fear becomes self-reinforcing. Every 14% VIX spike triggers margin calls, which forces liquidation of the weakest names, which amplifies the next move. What protects you isn't sector bets. It's whether your core holdings can withstand 3 more days of this pattern without forced selling. The consensus among the Canary community is that today's correction represents a buying opportunity for quality dividend yield names rather than speculative growth stocks, as evidenced by the capital flow patterns into XLP and bond versus the hemorrhage from SMH and ARKK. The verdict: tech fatigue, combined with geopolitical flashpoint, creates perfect conditions for sustained volatility over the next 7-10 trading days. Watch whether oil stabilizes or continues climbing. If it breaks $85, expect another 200 basis point VIX spike as margin compression becomes unavoidable. Canary sign-off: build your immunity now by shifting toward cash flow positive sectors that historically outperform during geopolitical stress periods.